Finally, Foschini, which is a brand that was invented by an Italian man. I don't know, he wasn't an Italian man. There's a guy called George Rosenthal in central Johannesburg in like 1924. He thought, this sounds Italian. So he opens a department store.
Yeah.
And from there, it's grown, of course, into this multi-brand business that sells fashion, jewelry, accessories, cosmetics, all sorts of stuff, all sorts of brands as well, like Sports Scene, Total Sports, Due South, others that people will be familiar with. Phase 8 is a UK-based business, which is a fast fashion retailer, which they acquired. So you're going to need to take that into consideration as well. 13.6%, no, 13.6 price to earnings ratio, 4.9% dividend yield. Market capitalization also pretty hefty, 31.59 billion.
Yeah.
So what's different here? Phase 8, a little bit bigger, a little bit different in its outlook?
Yeah, a little bit bigger. I mean, I think what you can see from this group is a much more diverse brand portfolio. They're really competing in the activewear sports side, outdoor, jewelry, clothing, fashion, etc.
Because jewelry is like American Swiss, Stearns, that kind of thing too.
Correct.
A lot of cell phone sales at home as well.
Yes, yes, correct. So, you know, you've got different drivers for earnings in this group. You've got the Phase 8 coming in. They also made a recent one, Whistles, was that new acquisition as well that you know, the market was quite excited about. So they're doing things. They're not sitting back, and they're adding, you know, meaningful acquisitions to the group.
Let's look at the chart, because that will reveal how the market feels about it. So it did have that surge there, then got a little bit kind of beaten back. And lately it's been better, but it suffered sharply in recent weeks as a result of this kind of sentiment-driven sale of anything that is credit-exposed and South African-oriented.
And it would, because it is still very much South African-facing. They are, as with many of the companies we spoke about, trying to diversify out of that. But it's a consistent operator, you know, despite the diverse brand portfolio, strongly cash generative. And you've got to remember the gross margins that these companies command are meaty. You know, they have 50% gross margin. There's a lot of fat there to play with. So, you know, the business models are not in jeopardy. Profitability might come under strain in the short term.
And you would think that the foreign earnings, the pound-based earnings, would translate well. Yeah, and as you say, Doug Murray and Anthony Thunstrom and a lot of their predecessors in the management suite have done a very good job over the years.
Yeah, correct. I think it's worth noting that the management team and the succession in this group particular has been strong. It's been consistent.
Yeah, but the underlying concern would be a macro environment concern, and that would drive investors perhaps to adopt a wait-and-see attitude, seeing how this credit cycle turns out, what kind of collateral damage there is.
Correct.
And they did reduce their credit book quite substantially by selling RCS, but they still have like a 7 billion or thereabouts rand worth of loans extended into their existing customer base using their Foschini cards. Okay, so, hot or not?
Look, I mean, I think at the right price, I like the group. Yes, there's a lot of, you know, headwinds, but, you know, I think their brands will take them through. I'm actually going to go hot on this one.
You're going to go hot?
Yeah.
Okay, I'm going to err on the side of caution here with the locally oriented or mostly locally oriented groups and go not. So you can tell rather that there's a little bit of kind of it's a tricky one.